and welcome to the Build and Exit podcast. I'm Julie Wilkinson. I'm the owner and founder of Wilkinson Accounting Solutions, and I started the podcast off the back of the work we do because I realised there was a big gap in the SME market for wealth planning and people maximising wealth on exit when they eventually sell their business or have a legacy business. So I'm really excited today to have Rachel Murphy. Hi, Rachel.
Hey, Julie. I'm delighted to be here. Thank you for having me on.
No, thank you for coming. I love Rachel's story. So just a bit of background about why we've asked Rachel to come on the podcast. So she's a 2 times exit founder and going through a third. We're going to focus on one of those exits today. There was a business where she actually got an 8 times multiplier. So I think that's going to be an interesting story. And she's also founder of the Grafter. And I suppose after her exits, the principle of what Rachel does now is she helps other founders sort of scale and exit their business successfully. So I think there's going to be a lot of knowledge and support for businesses looking to scale, really. I suppose it's a little bit of a different podcast because sometimes we focus around the acquisitions. And I think today is going to be quite a heavy focus on the exit, which I think is going to be exciting. So first of all, Rachel, I want to thank you for coming on and hand over to you to see why you wanted to come on the podcast and a bit about yourself.
Real thanks, Julie. So I, from my perspective, just keen to share the story and to, I guess, build awareness that it is possible to build and sell businesses. In particular, from a female founder perspective, I think there's probably fewer of us than the male equivalent. So it's nice to balance the books a little bit. And in way of background, as she said, I have built and sold a couple of companies. And the one I'm going to talk about today is a business called Different. And Different was a consultancy. And we designed and built services for public sector, in particular, healthcare. So that business was sold back in 2020, but it was a relatively fast concept to sale. So concept to sale was over a period of 1,000 days.
Wow. Yeah. So, and I know we're going to delve into a bit about this exit, aren't we, in the podcast today? So I suppose it's a good place to start, really, is, how did you scale that? Like, what was the starting position of that business? I mean, did you have in mind when you started it that you was going to sell it, or did that just happen?
Right from the start, I was really clear and intentional that it was going to be an in and out in 5 years, and it was important to me that that was the approach, and that the senior team were aware of that. So the business had been running as a recruitment company, and I jumped in, and my kind of pitch to the previous founder was give us 50% of the business, and I'm going to move this from a recruitment company to a consultancy and actually own the delivery of these outcomes, and therefore drive the profit margin from 10% up to 30-40%. So the business had trading history. It was on a couple of government frameworks. And so, we definitely had a bit of a head start from that perspective.
Oh, interesting. And it's interesting you say that about, so you did actually acquire into it then, when you then had the exit plan.
It's funny because I never look at it like that. But yes, you're absolutely right. I did acquire into it. I acquired in with a convincing sales approach that give me 50% of it, and I'm going to drive the number very hard and make sure that we exit within a 5-year period. So yes, I never really think about the fact I've done acquisition, Judy, but that's a bit of a revelation for me today.
There you go. And I suppose, but it's a good point though, because do you know what? One of the learnings I think I've had from my business journey is I don't know if I'd ever start a business organically again. I mean, I just think, why reinvent the wheel when people out there have already built it? And some people get a bit, emotionally attached to the businesses. But in the end, on your deathbed, when you're handing down your legacy to your family, they're not going to be saying to you, oh, I don't want the money because you didn't build that business from scratch, are they? Nobody's going to be saying that. You still have to be, even if you acquire into a business, you still have to have an entrepreneurial spirit and be skilled at running a business to make it a success. You can't just buy in and then sail off to the sunset. Well, some people might be saying that you can, but we all know the truth. The people that have done it know the truth that you can't do that. So I think it's an interesting concept to actually think an intention there, because do you think that a lot of maybe organic business owners don't go into their business with enough intention what the end result of that business is?
It's really interesting because this is a conversation I'm having a lot from a blogging and conversation with other founders. I don't think they do. And I think it's a taboo subject to talk about it. And I think that's wrong. And I think it's wrong because exit doesn't mean necessarily selling the business. It could be a management buyout. It could be lots of things. But I think if you're not clear and you haven't got a plan about where you're going and what you're doing, I do think that you run the risk of perhaps not making strategic decisions about the direction of the business, but also, giving yourself the chance to take a step back, look at what you've achieved, look at what you've done, and make some decisions around you as the founder and what do you want from life. So I guess that's what's prompting a lot of my discussion at the minute with clients we're working with and wider. And no, I don't think that lots do. And I think that should, I think it needs to change. And I don't think it should be this taboo that it appears to be at the minute.
Yeah, I agree. And I'll just give a little bit of my insight, because I speak to hundreds of business owners. And I think when people get to 7 and 8 figures, they maybe forget this in the early journeys. But I believe one of the biggest problems when people are starting business is organically is their first thought is, I've just got to pay myself. And I would say that's probably a bit of our cultural society, because a lot of people potentially are moving from jobs, so from corporate jobs.
Yeah.
And I was the same, actually. If I'm truly honest, when I first started the business, my first thought when I started was, I just need to make my salary. That was what I thought back then, because I didn't know any different back then, because I'd come from a life where I just worked in jobs and got a salary and spent my salary every month. The average statistic is the average person's only 3 months away from bankruptcy.
Yeah.
Because we don't have a lot. Even if you earn a lot, you don't really build any accumulative wealth. So then when they're pricing, I mean, I'm probably a little bit different maybe because of my skill set. So I didn't really go into my business like this. But I think a lot of businesses that they then move to get this freedom. And because their first thought is they've got to pay themselves, the pricing's too low, but not always too low. Some people will say, they're not necessarily really undercharging. So they're not maybe like really undercharging, but maybe they're not charging enough to then get investment cash.
Yes.
Because to then scale and do these things, I think you do need cash flow. So you need to be able to afford to obviously pay yourself, pay your wages or whatever, you've got your overheads. But then you need some investment cash there, because those overheads are going to grow. So if you start off in the first couple of years that, not doing that, then it escalates. And I do believe, because I've seen it, there are businesses now out there, 6, 7, 8 figures that are still in this cycle, because they're still... Because the cash flow is still constrained.
Because I think it depends a lot on whether it's bootstrapped or you've taken investment into the business as well. And of course, there's certain businesses that it's easier to bootstrap, services business rather than product. But I think that balance and starting to think about it in way of, it not just being, it not being a job, it actually being a business is another challenge for a lot of founders. So yes, I agree.
Yeah. But anyway, so it's interesting because we've got another podcast launching next Monday, and I won't ruin who the person is. It'll be a surprise, but that's quite an interesting conversation, because the difference between the investor mindset to the operator mindset, because they're actively an investor, and I find it interesting because business owners don't often see themselves as an investor.
Yeah,
because they will go, I don't want to get funding for my business. But my first thing is, but anybody that is putting time into their business and not getting paid for it, which the average owner really isn't, because even if they're taking a big salary, they're often doing, say, 60 hours a week. And 60 hours a week isn't one job, that's actually 1.5 jobs. Yeah. So therefore, does your salary actually equate to market value of 2 jobs? And if it doesn't, then really, you might still get a good salary. But if you were going to commercially look at your roles, you wouldn't be getting the right salary, because you wouldn't go to a corporate firm and then not get paid, would you? So they don't see themselves as an investor from the start. So I think the investor mindset's quite interesting.
Yeah, I wholeheartedly agree. And I do think that coming at it from your skill set as well gives a different perspective, which is really useful.
Yeah. So anyway, back to your story. So you did that. You got into this business and you had this plan, which I think is brilliant because I think you're right. I don't think enough people are doing it, and I think it's partly because they're scared because they don't actually know what they want. That's probably the biggest problem. But that goes down a whole other avenue, I suppose. So anyway, but you did have this plan. So just interested to say, like, how did you attack that, approach it? Like, how did you get the people on board and things like that? Because obviously there was obviously staff there at the time, was there, when you acquired it?
There was only a couple of permanent people, so it was very lightweight in way of permanent. The majority of the business was about placing contract resource from a recruitment perspective. So it's very easy to, I guess, to kind of pivot the strategy of the business. So the initial stage was about being really intentional about what the mission of the business was and making sure that we were going after business that was in that outcome space, albeit it took probably 6 to 12 months. And the reality was we did work in sectors that weren't the sector we knew we wanted to go and work in. From a cash flow perspective, we were bootstrapped, we didn't take investment to make sure that we were covering costs, building out our services properly as we went on that journey. So you're absolutely right. You can do it one of a couple of different ways. I think it's a little easier in services if you have a big network and you are not afraid to use it and therefore leverage that network as a bit of a springboard while you're building out the business. And that was very much the approach. So the new people that we were hiring in from a permanent perspective were hired on the basis of consultancy and owning outcomes. And what we did with the internal team that were recruiters was we actually had them start recruiting for us as the client. So there wasn't a huge shift in way of how the business operated. It meant we could move probably faster than you would be able to normally.
We haven't talked about this, but I'm going to put you on the spot a little bit. So what do you think was the biggest challenge, though?
God, there was loads, Julie. So I would say there was a challenge of business partner who was used to running a recruitment business, moving over to an outcome-based delivery business. There was, the systems from a software perspective were all about recruitment, not about running a consultancy. So we had to make investment in new services to underpin that. We had to convince clients that we were no longer a recruitment business and we were a consultancy almost overnight and have them trust that we could deliver outcomes and own the risk. So there was plenty of challenges, but I think it was made easier because I spent 20, 25 years doing turnaround transformation work myself. So we lent hard on my personal reputation for a period of time while we grew the reputation and case studies of the business. So it was that was, I guess, how we navigated that in the very early stages.
Yeah, it sounds so close to, because obviously mine's a service-based business. It sounds so like close to how we've been running the business since our acquisition. So yeah, feels quite personal actually when you say that, because I relate to a lot of what you're saying there. Anyway, so I know you did this scale and you had this exit plan, and then I know there was a bit of time around COVID, wasn't there, that your business had, I suppose, a bit of a revelation, shall I say. So I think it's interesting, this part of the story, because obviously I know there's a lot of negative things that happen in COVID with the deaths and people lost their businesses. But obviously I always believe there's opportunity everywhere. And I know that you guys had a bit of opportunity in COVID. So do you want to share a bit about what happened?
Yeah, of course. And I think in that, Julie, we're probably very similar. So for me, I would always see the positive in any situation. And a lot of the services that we built were national services for government or for healthcare. And so as you go into a pandemic, we were asked to build the home testing service for COVID-19. And we were asked to build that in a really short window. And it meant that we actually had to put split shift team 24 hours a day to build that service. But the end result for us meant that we probably wrote 500,000, maybe 750,000 of net new business that we weren't planning to write that year. If you work in healthcare and you're building services and it's a pandemic, you could argue the timing doesn't get any better. However, I will caveat that with, from a personal standpoint, very asthmatic, was shielding, found it particularly tricky. But equally, from a business perspective, there was opportunity, and we delivered those services. We have a letter of kind of thanks from Boris Johnson for delivering those services, and we built that COVID home testing service and put it live very quickly. So I think being able to pivot as well and respond and move really fast. And we didn't have everything in place. We didn't have a purchase order. It was a bloody nightmare getting that payment out of them in the end. So, from an accounting perspective, a lot of it we didn't do the right way around. But there's also an argument, I think, when it is a pandemic and you work in healthcare, that it is a bit of a calling. It was a call to arms. We got stuck in, we made it happen. And I had every confidence we were going to get the purchase order settled, despite the fact at varying times it was challenging. But for us, what that meant was, as we were going through the process then of courting 3 potential buyers, it had a direct impact on the multiplier that the buyer bought us for, because of course it drove our numbers upwards. And I guess you could say there's 2 schools of thought. You can either look at it and say, I'm an incredible founder and I timed it perfectly, or you can be honest and say we got bloody lucky. And I subscribe to the latter view, Julie.
Yeah, but there is just risk. I mean, my journey, I officially started Wilkinson's in Jan 20. So obviously just before. So I had left my job in 2019. Then for the back end of 2019, I did sort of a bit of a contract. So I was just being a contractor. And it was actually in around the December 19 that I sort of thought, if I'm going to build this business, I need to not really be officially contracted or have a job.
Yeah.
I need to move. So that happened in Jan 20. So obviously then March 20 came and I was a bit like, and I had no online presence at all. I had like nothing, because I hadn't really, obviously I'd done a little bit, I'd had a bit of coaching and built the odd little bit of service up in the background, but nothing major. So obviously I kind of just started from nothing just before COVID, but I thought, I've done it now, I suppose you just got to get on with it. And in the end, everything was okay. There were some opportunities in it, because although some people go, all the clients not spending and stuff, actually some people were investing because they knew that they needed to do things differently.
Yeah. And I think that's part of that's though the mindset, isn't it? It's the, we're committed, we're on this path, and we're just going to hustle a bit harder and make it happen. And I get the sense that we may be cut from the same cloth in that respect.
I think so, yeah. So anyway, so this happened and you're getting the interest. So how did it all end up happening with this 8 times multiplier then? What was the exit like?
So, the exit was interesting. The initial thought process from the buyer was it was going to be 6 weeks. I didn't believe for 1 minute it was going to be 6 weeks. It ended up being about 6 months. We went through a period of exclusivity, and we moved from 3 offers on the table, went through kind of heads of terms and exclusivity. And it was challenging, that negotiation. But our EBITDA was over $1 million. And so from a multiplier perspective, in line with the market and where we were, that meant it kind of ratcheted up what the multiplier was looking like. We'd also done a phenomenal amount of work on our brand, and that played a really key part, because the brand is not normally considered for businesses of this size as part of a multiplier, but because we built such good reputation, and the brand was so synonymous with delivery in healthcare, that played a key part as well. So we did end up with an 8 times multiplier. And I was at a health conference yesterday, and we were talking about multipliers for businesses similar to ours today, which wouldn't exceed probably 3x. Now, the market's distinctly different. There was a lot of money being sunk into healthcare because when it's front of mind and people around the world are dying from a disease, healthcare, at that time, there was an awful lot of investment. But I think the market is probably on the low side right now, and it will bounce back up. Will it bounce as high as 8? Who knows? But we negotiated pretty hard as part of that process. And as you know, it's a balancing act, isn't it? Because you've got earn-out periods in there. There's cash and there's paper, but there's also restrictions. So all of it comes into consideration as part of that negotiation. But I think it was absolutely the right deal.
And what happened? And what was the deal? Did you have to do an earn-out? Did you work after it got sold? Or?
Yeah. So I stayed on. Business partner didn't. I stayed on for an 18-month period in the business that bought us. But then post that period, I then had restrictions about building another, similar business for a period. But all of that, as I now know, is relatively standard. And of course, they're not going to make big investments like that if they're if 5 minutes later you're going to rock up with a new business name and start competing. And I'm still a shareholder in the business that bought us. They're a listed business, and I strangely was with one of the board members yesterday morning, so still very interested and relatively active in that market. So it all played out. According to plan would be quite a sweeping statement, but these things never go according to plan, as you know. But it taught me a lot of lessons that period.
Yeah, and it rolls on quite nicely, doesn't it, to sort of what you're working on now then? Because I know you're helping these businesses sort of scale and exit. What made you? Just out of curiosity, what's your view on the market in terms of the exit planning? What have you seen?
Well, I think it goes all the way back to where we started. I think that it's a taboo subject around people ever wanting to talk about an exit. I don't think it should be. I just don't believe that there are services to support entrepreneurs going through that journey. And that's really, I'm just another entrepreneur who is trying to solve a problem that I had, which is why plenty of us build businesses in the first place. But I found it tricky navigating through that process, even with an incredible lawyer. And I spent a lot of time after the exit and wrote a series of blogs, I don't know, probably 20,000 words, maybe more, around the concept of sale of the business. But as I completed that, I realized that I don't think there is the service out there to help founders to plan for exit, to think through how the business needs to be structured from a board perspective, creating artifacts so you're not having to do all of that T-minus 18 months from any potential go-to-market for sale, and starting to think about what that looks like, and think about potential buyers and competition. And that was what prompted me to build. I didn't intend to build another company straight away. I built a service called 8-Figure Exit, and it was all about sitting alongside a founder to help them get ready and think through the technical side of an exit, the financial side, but also the softer side. What did they really want? And you're absolutely right. From your earlier comment, I do think that's in a lot of ways, the biggest question and the hardest to answer. So being able to coach them and work some of that through is super important. So I built this service, and miraculously enough, like all good entrepreneurs, it became a company about 5 minutes later. And we have been running the business now for about 15, 16 months, and have taken a number of clients through that program, 8-Figure Exit. And what we normally find is that businesses have varying views on the valuation. And once we do a diagnostic of the business and do a valuation, we then tend to sit alongside and help them grow and scale the business for a period before they move through an exit process. So a lot of clients we're working with are working back from a 5-year plan around exit. They're not trying to sell in half an hour. We're probably not the right outfit for that. but that's what we're doing. We're working with businesses that are 2 to 40 million in word turnover, and they tend to be healthcare is a big love affair for me. So lots of businesses in healthcare, recruitment, consultancy, building digital services. Got some in the data space, talking to some franchisors about doing some work with them. So we're not going to try and go super wide. We want to really play to our strengths, where our domain expertise is. We've now got 7 exiteers that are working with Grafter, and they have to have sold a business at least a couple of times in a domain area to have that expertise. So that's what we're doing at the minute, and it's great fun because it means I get to work with entrepreneurs all the time, which is brilliant.
Yeah, no, and again, it sounds quite close to my heart with what we've done and where we've transitioned, because I think we're a bit unique in the accounting world, because obviously with our acquisition experience and also our corporate experience, we find I suppose we've transitioned a little bit, because we used to be known a lot as like our acquisition CFO. So a lot of our organic clients, obviously we did our acquisition, so we have our bookkeeping and tax services. But before the organic, we were sort of known as acquisition CFOs, which we still are. And a lot of our clients were buyers that came that were buying businesses. But we realised actually that people needed a lot more than that, because when people are buying businesses and they're already running businesses, it can cause them, some complications. It doesn't, make the deal break and the businesses still continue, but it can be hard on the owners, and people can have some sleepless nights. So what we try to do, what we're looking to do now, is we're getting on board with people who are wanting to exit, maybe considering acquisition as a route, because I actually think the best people that buy businesses are the ones that have never thought about it personally. I think these ones going on these courses that are being pushed by these no money down deals, I just think they're often the ones that don't have a lot of capital, perhaps can't invest. But normally, like good businesses, like you say, between 2 and 40 million that are running good businesses often have a lot of capital. And then we look at their current infrastructure, and go like, what's your financing? Because obviously we come from a finance perspective, and then we look at, this is your current structure, this is what best practice is. So if you were in corporate, because I do think you can bring a lot from corporate into an SME. You might not need all the red bells and tail. I'm not going to say it needs to be as official, but the structure should be there, because the governance and controls over, at the end of the day, how do I stop? What's my biggest risk? And what controls and processes do I need to not have that risk happen? Should always be I believe should be at the forefront of everybody's mind.
I agree.
And that's one of the things that we focus on in the accounting. So we still have our acquisition CFOs, and we go through those buy and build strategies. Like I said to you earlier, I think we've got about 6 deals on at the minute. But it's for me, it's more than just the acquisition. The acquisition is just a means to a wealth, it's just a means to a growth strategy. It just spearheads the growth. It's not the overriding principle of the person's objective, because the objective is normally, I want to exit with wealth. So the acquisition is a mechanism to do that. But also, if an owner's too busy, because there's a lot of owner operators still in 6, 7, 8 figure businesses.
Yes.
And if you're too busy in your current business and you suddenly do this acquisition, and then that acquisition doesn't have an MD or a CEO, which most of them don't, averagely, do they? Then what does that business owner do?
And I think that you've hit the nail on the head. One of our clients at the minute debating doing exactly that. And our steering advice is, you're not in a position, and it's been the integration. There's so many businesses that are acquired that manage to balls up that integration. And if these are people businesses and you're trying to treat people like commodities and just, throw them a new email and hope for the best, here's the news, that's going to go sadly wrong very rapidly. So yes, I agree. And I do think we're starting to see more and more of this entrepreneurship through acquisition as a movement in the UK, whereby, previously it would have been very US centric. I mean, it's probably not even a term I've heard over here too much until the last 12 months. That might be a bit naivety from my side, Julie, but I'm definitely sensing there's a bit of a bow wave in that respect.
Yeah, I think it's exciting. And, we're talking to a lot of businesses that are, in this position, because we find that what's happening is the business has grown. the amount of time, the biggest thing we see, especially in the finance area, is the promotion of, I suppose, unqualified people. That's the biggest problem. So they've got a CFO, but the CFO is not really a CFO. It's the wife or the husband. They're not qualified. Perhaps they have done the bookkeeping for years, but if no one's ever checked the bookkeeping, then how do you know if the bookkeeping they've done is right? Or they've got, they've had an admin assistant. The business grows, that admin assistant starts processing invoices, and suddenly the admin assistant is now the finance manager. And the thing is, they're putting people at risk because these sort of unqualified staff are being asked to run multi-million businesses. That's what they're effectively doing. They're running finance departments of multi-million pound businesses, and it's putting the business at risk. It's putting them at risk, because they're probably out of their debt, and people only know what they know. So they might not be lying. Perhaps they say, oh, yeah, I can do that. But then if you've never ran a multi-million pound operation before, or been a finance director or a senior managing other people in finance, how do you know what you should be doing? And then the CEO doesn't know what the finance department are doing. They perhaps have never worked in corporate. They've never hired a finance department. So then they don't know what that person should be doing. And if the finance department isn't right, the whole business is technically at risk.
Yeah,
because if nobody manages the cash and nobody manages the profit, then there isn't a business at the end of the day, is there? So
it's funny because I'm in the process of writing a blog about exactly that subject. At the minute, we should have done a double act on that blog, Julie. But financial management is not sexy. But here's the news: if there's no cash coming in, then you won't be paying anybody, and it will be dwindling pretty rapidly. So you're preaching to the converted.
So anyway, we're sort of coming towards the end, and it's been really good. I think it's such an interesting story, Rachel. I am going to say it. We like to call you the legend, don't we?
I mean, I'm very happy with that as a title.
We like to call you the legend. So maybe you could just give a bit of if anyone's obviously with what you're helping people with, if anyone is looking to get some help on the exit, what's the best way to contact you?
So best way is through the website, which is thegrafter.com. And we are starting to move to cohorts that are sector specific in way of the 8-figure exit program. So we're running one for health founders. So anybody working in health, be that pharma, life sciences, private, selling into the NHS. We're going to run a program starting on the 25th of November. And we have, without sounding too bloody salesy, we have got a couple of slots left for that program. And I and all of our exiteers will sit alongside their businesses for 16 weeks and take them the whole way through that process. So that's kind of direction of travel. But for more information about what we do, it's thegrafter.com.
Yeah, well, thanks for coming on, Rachel. I definitely think people should reach out because I don't think enough people in this country are maximising the reward for their hard work. And that's what it comes down to. People are retiring, dying, and they could leave these legacy businesses to their family and they're just not preparing it enough. So I think it's an important topic that we need to sort of get better at here in the UK, basically, is my view on it.
I agree wholeheartedly and really appreciate the opportunity to talk a bit about my journey, but also about the business, Julie. Thank you very much.
No, thank you. I just want to say thanks to all our listeners. If you do like the episodes, hit the subscribe button because it does help more people find the channel. And I'll see you again soon.